All right, great. So I'm not going to introduce myself because you guys already heard that, but we are going to start with our first sort of financing panel. This one's called the Visionary Roundtable Financing Solar in the U.S. We have a great set of sort of very well-informed and very well-positioned panelists who are going to be able to share some great insights. We're going to try and keep this somewhat structured, so there'll be quick intros from each of the panelists. Then we're going to have like kind of a moderated discussion, and we'll try and leave a good chunk of time at the end for sort of Q&A from the audience. What I would suggest is if you can start writing down your questions and try and think of someone specifically to ask it to. So they all have little name tags there, and we'll have them introduce themselves so you'll have a better sense of what their areas of expertise are. So with that, I'm actually just going to have our first panelist, Travis Bradford. Go ahead and kind of kick it off and introduce himself, your role. And
really? You want me to go first?
Yeah, well,
all right. Hi, I'm Travis Bradford. I founded the Prometheus Institute for Sustainable Development and developed a lot of market research, some of which has found a home at Greentech Media. I also teach at the at various graduate programs, courses on energy markets and innovation. I'm currently at Columbia's policy school. But in the winter, I'll be at Duke, and in the spring, I'll be at the University of Chicago MBA program.
Thanks. Melissa?
Hi, I'm Melissa Wilson. I'm from Union Bank. We're an $80 billion institution. We're actually owned by one of the largest banks in the world, Mitsubishi UFJ Financial Group. Our department's been leading to the energy business, our bank for the last 30 years, and our department for the last 15 or 20 years. What we focus on is both tax equity and debt for the solar, the wind, the renewables business. We have about $3 or $4 billion of investments in that area, of which about 24 of them are debt related and about 24 of them are tax equity lease related. So happy to be here.
Great, thank you.
Hi.
Is that on?
I think so. Hi, my name is Mike Mendelsohn. I work for National Renewable Energy Laboratory. I work in the Energy Analysis Center, and I'm working on various financial issues. We have three main focuses as part of our mission: to collect data and provide that to the public, to build tools that can be used for project evaluation, and conduct analysis on best innovations at the local, state, and federal level, and look at trends and barriers across the industry. Thanks.
Okay, thanks. Jimmy?
Hi, my name is Jimmy Chuang. I run the global project finance for GCO Solar. GCO Solar is one of the largest solar companies in the world today. We're the largest wafer manufacturer from China, also the largest IPP in China as well. So in the States, we have around $6 billion market cap, and we have a close partnership with China Investment Corp to invest on operating assets in the States.
Good afternoon. My name is Chase Weir. I'm the CEO of Distributed Sun. We're a commercial solar developer focused primarily in the Mid-Atlantic. We're about to hit our 2-year anniversary. We're deployed with operational assets in 4 states, moving into the Northeast now and the Southwest. We look at our business as everything after manufacturing the value chain. Either we do it directly or we do it through a networked approach. We've recently launched the Distributed Solar Network. We're about to commission megawatt scale power in December in New Jersey. We just announced the largest solar project for New York City, largest commercial solar project for Delaware, a 29 building solar array, and pleased to be here.
Great, thanks. Well, we're gonna start kind of with maybe a little bit more of the utility side of sort of project finance, and maybe dive a little bit into commercial and residential on the way. This section of the panel is going to be a little bit more focused on sort of high-level themes of project finance and the debt side in particular, and we'll have a separate panel coming up next, which will be on the tax equity. So actually, just in case you feel like we're kind of not covering tax equity in much detail, that's intentional. So the first one that I thought would be interesting was just, kind of maybe tying back a little bit to the slides I just presented. Obviously the loan guarantee program has been massively, it's massively successful in some ways, massively criticized in other ways, but it has in fact put a lot of money to work on large-scale solar projects and also some rooftop solar projects. The question I would have is, with that now gone, what does that portend, or what's going to happen next year in terms of filling that void? Do we see the traditional sort of European and Japanese banks that have financed wind projects stepping up and really kind of playing a major role and putting billions to work in solar? Or are the U.S. banks, such as Goldman and Merrill, going to play a much bigger role, or what do we see happening? So this is kind of open to the entire panel. I don't know, Melissa, if you want to start, maybe?
Well, I know we'll be lending money, so I can say that with 100% surety.
Can I get your card?
Absolutely. It's a really good question. It's interesting because there's so many different competitors in that market. I'd be curious to see what some of my colleagues on the next panel would say. I think any of the above, I don't have a real exact sense. I think we'll have to see what the market turns into next year. I don't have any particular new players in my mind. If I did, I probably wouldn't want to share them up here.
Sure. Okay. Anyone else want to, Michael?
I would suggest that we're going to see a focus back to smaller projects. These really large-scale deals are going to be a lot stickier without the loan guarantee program there. So we're going to see more of a focus on 20 megawatts and below, which will be a lot easier to do with the single bank, especially. And on the loan guarantee program, I wanted to mention, because you indicated earlier that the cost was really, the guarantees were really loans by the FFP, but really the cost to the government is really just only the credit subsidy cost. And that was paid for through ARA, although historically that was sort of self-insured where it was pooled. And that cost, if you look at the megawatts out of that project, out of the loan guarantees, that the cost per megawatt hour is actually quite low. So it was a very effective program in getting a lot of megawatts in the ground, a lot of megawatt hours out of these large projects, hopefully. But I think it'll be seen historically as a really cost-effective program.
So loan guarantee probably works pretty well for the new technology, like CSP and whatnot. For traditional crystalline PV, we don't need loan guarantee too much at all. So last year we closed 10 megawatt financing with Wells Fargo, and this year we are raising another $200 million financing, 200 megawatts, so $600 million financing. Now there's a loan guarantee to pure debt and tax equity financing. And the credit market is very strong right now. I mean, it was pretty strong a couple months ago, but now the European credit crisis, I think some of the European banks are pulling back a little bit, but I think in general the credit market is still pretty strong, insurance market is still really strong. When you have a good financeable project, I think there's still money out there.
I would add on to that, obviously in the commercial space, we're not dealing with the need for the loan guarantee. We're actually seeing the opposite effect. Having now successfully deployed and brought projects to profitability, our cost of debt's going down. So that's a bit of a bright light for us in 2012.
Okay. Travis, anything? Are you good?
No, not on that issue.
Okay. The next one that I want to talk about is a question that we at GTM get asked quite a bit, which is that we have kind of a very detailed tracker in our Solar Market Insight product that sort of shows, here's how much residential got installed, here's how much, commercial, here's how much utility got installed. And, so every quarter people take a look and they're like, okay, so you installed 50 megawatts of utility. And then they look at our forecast for where utility is going and also the pipeline, right? So we actually have a tracker product that shows that we have, somewhere in the neighborhood of, I'm not sure where it's at today, Shale, but it used to be somewhere in the neighborhood of 13,000 megawatts with signed PPAs, right? So that is a massive number. And one of the questions we've been asked is, well, if there's 13,000 megawatts and we're installing X per quarter, it's going to take us 50 years to work through that pipeline, right? So clearly something's got to accelerate, or a bunch of these projects are never going to happen. And we ask, what's the holdup on these projects? They already have PPAs signed. Oftentimes they've got the environmental permitting, everything sort of on that front in place. So it seems that it's financing, right? It seems that financing is holding up these projects. And so, I'm curious if anyone on the panel wants to talk about, what percentage of these 13,000 megawatts are actually going to get built, or are there ways that things will loosen up in a way that a lot more of these utility projects that have PPAs will get built? My sense is that part of the problem is probably related to the returns that are being offered to the equity investors, right? That the PPA prices are too low. But I'd be curious if folks on the panel want to comment on what is it that's holding up this 13,000 megawatts of
I'll
finance?
leave with that, and
That's it.
my colleagues can take different opinions, but I think it's kind of, you hit it on the head. For the deals that we've seen, not all of them are utility scale, we see commercial scale, we see other types of deals, but I think there's a large population of deals that just don't make sense financially, and I think that the underpinning is the PPA generally. So some of those deals just won't ever get financed because they don't make sense to get done in the first place. The unlevered after-tax IRRs are low, so low that the deal's not economic for the sponsor, much less to have it financed. So I can speak to a portion that won't get financed. There's a few thoughts I had on that.
Like, is that half of the projects that
Yeah,
you see?
it's a large population what we see, but I don't, there are deals that we do too, so it's, I can't guess, 50-50, 25-70, I don't have a good sense of that.
Anyone else? Michael?
I would add that, developers are seeing module prices drop every quarter, so they're trying to hit this target up ahead. And so hopefully the PPA in the future, when it's all said and done, when everything's finalized, that the module prices will be at the place they need to be to provide the IRR. So it could be then in a quarter or two that if the PPA is still viable, that the project pencils out and it could get done in the next half year or so.
Yeah, and I was going to say, that's probably the most important thing. None of this is happening in a vacuum, and module prices are coming down for their own independent reasons, which we've talked about and will continue to talk about. But when you have a PPA price, that price is in, then what you have to figure out is how to get the LCOE low enough to sort of have the adequate sort of rents and returns. And in order to do that, you can have the whole system be cheaper, or you can figure out new ways to make the financing sort of amortize over longer periods of time. I think there's some serious structural elements that are causing us to not be able to change our financing structures to sort of accommodate the real underlying risks and the real underlying sort of lifetimes of these projects that we need to address before we can really open up that pipeline.
So Travis, are you talking like having longer term debt perhaps, or like do you feel like solar projects will last more than 20 years and that's maybe part of the?
Well, I mean, I don't know that a lot of projects are getting financed with 20-year debt these days.
Right.
I mean, your slide suggests that they could be in the mid-single digits in terms of the debt terms under some of the projects. But I mean, so if you want to bring down kind of the cost of financing, you have roughly 3 levers you can mess with. You can bring down your or you can extend the term. You can get sort of your average duration of the project out. You can reduce the weighted average cost of capital, which is the weighted average cost of each of the individual components of that capital, or you can change the debt to equity ratio, which right now is absurd at something on the order of 50 to, in some cases after the cash grants are paid out, 60% of the project in some kind of equity. Those are relative to the underlying assets that we're financing here, those are absurd assumptions. And the fact that you've got a weighted average cost of capital for these projects up in the 12-15% range and tax equity requiring that chunk really screws up the entire capital structure. And it really all goes back to the notion that we have to have tax equity in these projects to make them work. I know we're supposed to talk about tax equity on the next panel. So we can take a break for that, and because the answer is yes, that's a bottleneck. And until we get out from underneath that bottleneck with alternate structures, and this is only going to get worse next year, particularly if the cash grant isn't re-extended. I'm not in the habit of betting against Roundtable, but it's still probabilistic at this stage whether some mechanism is available to fix this. And so, and we've got to get out from underneath those those handcuffs of how the tax equity is forcing us into these contorted, short-term, high weighted average cost of capital, messy, extreme debt to equity ratios, and make it look much more like, if we could just get it to look like wind financing, we'd be in better shape. But frankly, these things really should look more like commercial mortgages. And until we can get that structure in place, I mean, that itself would actually bring down substantially the costs and make lots of projects, both those that are already contracted and many that haven't yet been sort of priced out, economic, particularly as module prices continue to fall.
I would add to that, Travis is kind of singing to the choir. There, you've got cost of capital and you've got cost to install, and there's really no reason to believe that in 2012 the cost of capital is going to do anything but go up. You add to that an expiration of the loan guarantee program, and I don't see any scenario of acceleration of utility scale. But there are some proponents, whether it's Richard Kaufman talking about business development corporations, or Reed Hunt with the Green Bank, or Neil Auerbach with Hudson, provoking and testifying before Congress about master limited partnerships. There are, the industry is about to go through another generational shift, and I think that's actually very exciting. Over the long haul, I think you do see an acceleration, but as Travis said, until we get out of the private markets and into the public markets and can work out transferability and securitization issues, you can't see an acceleration. And so I actually see that things will slow down a little bit next year, but that there are some very promising things on the horizon.
Well, so GCL, I think, is a few companies actually want to build their own asset for 20 years, right? So we are borrowing 25-year debt right now, 20-year debt right now. So, but I feel the developer always ahead of us. I think the California deal I'm financing right now is a 2007 PPA. At that time, people thought the PPA price was crazy low, but since the module price going down so fast, and the deal become financeable, right? But a lot of deal people are signing out today, I mean, it's not financeable based on the cost and system cost and financing cost today. Maybe it could be financeable a couple of years from now, but based on today capital market system cost, those deals not getting done. The deals getting signed right now, getting approved by CPUC is not going to get done based on financing structure and the cost of system today.
So maybe we can follow up on that. So I don't know who amongst you is most qualified to address this, but I'm sure people in the room are interested, what are typical sort of PPA rates that you need to bid in order to win? And then separately, for a project that you're going to build, let's call it at the end of next year, what's a PPA price that you need to get that would actually pencil out and get someone like Melisa to provide debt, or get someone to provide tax equity that'll allow all the numbers to work? Like maybe the first question is, what do you need to bid to win? I don't know if anyone wants to answer that.
I can take that. I mean, again, it depends on the segment that you're in. But we just developed a tool called Acquire Us. We look at our overall project selection and banking process as having two bookends. One is to make very, very short work of the projects that we select. A lot of projects and business models come into our inbox. We have developers, and we have, well over 100 megawatt of pipeline right now. A lot of folks get stuck in the mud trying to make a project bank that's just never going to bank. So we took what are 6 analytical tools in between those two bookends. We call them databases and processing engines, and they sit atop everything from current SREC outlook to, on a state-by-state basis, looking at the real avoided cost of electricity. So we know and we presume that if we're going to get the project, we've got to come in with a discount. We've got to be competitive. Now, that's not the same if you're in merchant. You don't have to approach it that way. But we look at all the inputs, and so we're a little indifferent to the idea of a PPA rate. We need to know what Distributed Sun as a business needs to charge in order to not act like a 501c3. We have investors, and we have
Hey, there's nothing wrong with 501c3s.
Nothing wrong with it. But we're the shepherd of other people's capital. And our first solar energy investment company broke even in 15 months because we do this kind of work. So we know what we need to earn, and we know what rate we need to charge in order to win. It sits atop databases that throw in all the other inputs that drive an output yield. We know what the range of the EPC cost is, and that varies state by state. It varies by install type. And then we compare that against whether there are any intermediaries in the deal, and then the investment structure and the cost of capital. And so we know at a glance, state by state, type by type, whether a certain project will bank against a leaseback or against a partnership flip, and that just drives our conduct. So it's not PPA specific, and that's the problem. We talk often about two guys with a truck and a friend who owns a building, and together they have a solar dream. And the reality is, just because you can put your ear to the ground and ask somebody what they have to bid in order to win the RFP, and then you turn around and you present that project and what you want to charge and what profit you want to make, none of that has anything to do with the bankability of a project. And that's the whole definition of the distributed solar network, is socializing a rule set in a maturing industry. By definition, any value chain that goes through successive generations in a competitive industry has to drive value down to the end of the line, to the ratepayer. And so in our network, we kind of take the first hit. We're charging way below market development fees. And that allows us to begin the conversation with our partners with some authority that what we're not going to be is the impediment to the bankability of the project. And when we bring in partners who abide by those rules, we have certain finance. And so to date, we kind of look at our project success rate as batting 1,000 because we don't select projects that won't bank. That's how we look at it.
Yeah, well, actually, a slightly separate, related but separate issue is, I think for the folks in this room who are developers, or potential sort of investors in solar projects, one of the things that's come up is, in the current structure, you find a rooftop or you find a project that you think works, you then get 30% via cash grant, and okay, maybe you need to put in a little bit of equity, but you can get the rest via debt, and you're sort of away to the races. With the cash grant not being around potentially next year, for those smaller developers, the ones that aren't kind of in the sort of name brand category, if they have a bunch of these rooftop projects or even ground mount projects, but they're cash poor, but they're not big enough to attract the Wells or the JP Morgans of the world to put in the tax equity, what's going to happen to them, right? So are these projects just going to sort of be on life support, waiting for some magic small tax equity players to come in, or will they be sort of forced to sell them for pennies on the dollar to somebody like SunEd? I don't know if, I think, Mike, we talked a little bit about this. Do you have any thoughts on how this is going to play out?
Well, definitely smaller developers, those who who don't have the project portfolio to really lever that and attract tax equity. Those are players that are going to have the hardest time in a post-1603 world that will have to either, yes, as you mentioned, sell off their project pipeline or find a partnership arrangement, possibly, with a foreign manufacturer that can rely on a state bank, or other sort of joint venture possibility that can keep their projects going, or they'll have to sell off those projects, and we'll see a lot of consolidation in the industry. But I don't think we won't see sort of a consistent impact across the industry. We're going to see, some players, the SunEdisons of the world, and First Solars are going to be probably just fine post-1603. Transaction costs might go up, but they'll probably be able to bring their projects to market. But those smaller players with either less in the pipeline or possibly a more innovative technology that tax equity investors don't want to touch, those are players in the market that will have the hardest time after that transition period.
Okay. And then this question's, I guess, a little more for Jimmy. This is on the trend of sort of large manufacturers kind of getting a little bit involved in project finance. So, it seems like, there was some noise that some of the bigger guys were getting involved in sort of helping developers or potentially providing some of the debt. Do you see that continuing? Do you see that changing? Is there any impact that the Solar World trade case might have on that? I don't know if you want to try and start that.
Well, so that's a lot of question in one sentence. So I think, GCL is been around for 20 years, right? So our DNA is really IPP, but just happened for the past 4 years, we start making wafer, become largest wafer manufacturer. So we want to own asset, and for the past 18 months, we acquired 4 developers together around 250 megawatt, and 2 of them, they are smaller DG developers, so we aggregate them, and then we sell these back with Wells Fargo. So I think that works out pretty well because GCL been around for 20 years. We have a very strong finance development EPC team, so we can own operate asset for long term. So the tax equity feel comfortable, right, to work with guys like GCL. And I think, so, and your question is how the anti-dumping thing going to affect? Mm-hmm. Well, I think anti-dumping is happening, right? So I think people should buy module and ship into the States as soon as possible, right? So, yeah. Well, we sell wafer, but certainly we can be very helpful to procure module for you as well. So yes, I think, and so, but the anti-dumping could be interesting, right? Because I think eventually the module price will go up, right? Because the Chinese module price, if that happen, will go up. Someone going to eat a profit, right? Module developer or us. And the American module technology price will go up too. But we have financed deal when module is so much more expensive, right? $4 per watt, $5 per watt. When system cost was $10 per watt, right? So I think even at a 10, 20, 30 cents, it's not going to kill the deal. To someone going to make less money, good project will still get done. I think the PPA price people are signing right now, that's the key,
Yeah.
right?
So the PPA prices that you're seeing that are too low are what, 6 cents?
Well, I mean, if you want to win a PPA right now, you need to sign like a 7 or 6 cents right now. And we are closing like three different tax equity financing right now. And I know those PPAs not going to get financed, cannot get done right now. But if you want to win a PPA today, that's a price you have to sign up.
That makes sense. Okay, we're actually running a little short on time, so we're going to ask folks in the audience if they do have questions. Just raise your hand. We'll try and get a microphone to you. I think we have some roving mics floating around. So, anyone brave enough
So
to be the first question?
I'll comment on that while people are thinking of their questions. Yeah, the PPAs aren't going to get done under today's structures, right? I mean, and many of the elements of the structures are going in the wrong direction. The tax equity is going to be even more scarce next year than it is this year, even if the cash grant is extended, right? I mean, there's just, that pool of passive gains is just not growing, and we're not seeing enough movement into the space of the new providers. The structure's broken. We can get to 6 to 7 cent delivered contracts, but we have to fix the structure. And that means we're going to have to break our addiction to the tax equity market. We are going to have to relinquish this contorted sort of mechanism. Doesn't mean you have to let it go, you don't have to just not sort of get paid. You may get paid a little bit less, but if you can bake it into your own project and take it over time, you'll take a net present value hit on it, but it will allow you to simultaneously increase the duration of your loans, reduce your overall debt to equity, or improve your debt to equity ratios, and radically reduce your weighted average cost of capital. It's actually cheaper to get less value out of the tax equity, and you never have to ask permission again because it's all baked into your own project. That's the structure we have to go to. And however we get there, I'm going to leave that up to the brilliant legal minds in the room to figure out exactly how that looks. But we've got to get over this sort of insistence that we have to sort of use the structure as it currently stands. It is the single most limiting factor in the entire drive toward and well beyond grid parity that is economically inevitable. System prices, module prices, they've all done their part. We've got to, the financing side of this has to grow up and start looking like a real adult sort of financing structure, or we're going to be stuck at these prices and no deals are going to get done.
Well, I really don't think tax equity is a bad thing. So I think tax equity to make a bar higher, right? So think about other European countries, much easier to finance a deal. If everybody can finance deal, the PPA price will even go down further. Will go down much, much lower because just want to win a deal. If anyone can just borrow the money from banks and they get a feed-in tariff, I think that will be just, I mean, I don't see how different U.S. will look like compared to Germany.
No,
Italy.
that's what we have to do, is we
Yeah.
have to get to that structure. And we can't because the tax equity that we feel like we have to maximize the value of the tax equity in the first couple of years, and it requires us to have more parties in the transaction. More parties means more risk, more intercreditor agreements, more heterogeneity in the underlying transaction structures, which leads to an inability to securitize these later. I mean, that's not the way you build trillion-dollar capital markets. That's resigning us to having to sort of cobble together in a job shop method every deal that gets done until we actually just can't figure out how to do them anymore, or the tax equity market dries up completely and we all go find another line of work.
I think what you're looking for, Travis, is government ownership of all assets, no? Like there'd be no need for depreciation if the government owned the solar panels.
Yeah, I'm not sure that's where I was headed. I hope that wasn't the logical conclusion.
No, I hear what you're saying, though. It is for sure a problem. We don't have that much time. Was there any questions from the audience at this point? Anyone? If not,
I'll one-up it.
Go for it.
The people who are going to be in business doing deals are going to be the people that make this innovative leap. And that's it, right? There will be some people who will see how other people do it and follow, but not a lot of people are going to be able to do the volumes of transactions and get to the scale and be able to take advantage of this. I think the manufacturers can help here as well. There are other models where the manufacturers can come in and they can help provide, construction financing and some, long-term on the receivables for project components, and maybe even in the case of Chinese firms may have access to larger pools of capital to wrap the entire project. But, we're developing sort of models around commercial pace right now where you can sort of band together manufacturers and warehousing capital providers and then flip those into sort of long-term securitized bonds and wrap them with insurance products. I mean, there are models that exist in lots of industries, even industries that look a lot like the one that we're in, that we need to be pushing forward, and the winners are going to be the ones that make that innovative leap.
Okay. A connected question to that. Obviously the situation in DC is a little bit difficult right now. They're trying to find ways to cut money. Does anyone here have any thoughts on the safety of the ITC being around, or if it were to go away, what impact that would have on project finance? So Chase, I don't know if you want to start on that quickly.
Yeah, I happened to be in a room for most of yesterday with former Speaker of the House and Chairman of FERC, and a fellow who's driven most of the energy tax legislation through the past 2 or 3 generations, and it was pretty fascinating to see them unpack everything that's going on with the super committee and with the ITC and Department of Commerce issue. I think specifically to the tax credit, it's important for us to know the dialogue that's unfolding in Congress right now. I don't know that it gives us a crystal ball and tells us exactly how it will play out, but if you don't know what's going on with the dialogue, then you're a step away from being able to predict. Tax expenditures equal $1.1 trillion per year now. And up until really the past couple of legislative cycles, we haven't measured it or talked about it too much. The federal budget is $2.1 trillion. So the tax credit regimes equal greater than 50% of that. And that's all up for grabs, and it's on the table with the super committee right now. There are discussions about eliminating all oil and gas and renewable energy tax credits. I don't think it's going to happen. In fact, it's not going to happen with the super committee. And it won't happen next year because anything they do won't take effect until 2013. But what you need to understand is that tax reform is coming because we're in an age of debt and deficits. And the regime around energy tax credits is complicated. Right now, the definitions are, they're standards, right? You get a tax credit because you're wind. It's not because of performance criteria. And that's likely to change. So I think there is some risk. I don't think it's going to happen next year, and I think exactly what Travis is talking about and some other folks are provoking for, the maturity of the, what I would describe as new energy rather than renewable energy. The only new power plant of any real significance in this country that's going to be built going forward is gas, wind, and solar. And if you look at what oil and gas has received over the past couple of decades, they don't have a tax credit that expires in 12 months. They have an entitlement. There's no expiration. And it's very uniquely advantaged. So I'm actually not an opponent of tax advantage to help a very small and young, immature industry stand up. But there needs to be more clarity and there needs to be more certainty in it. So I don't have a prediction about ITC being eliminated. But I do know that it's being discussed.
Okay. I think we're just about out of time. So with that one, we give our panel a warm hand. Yeah,